All right, good morning, Checkmate crew. Today is Tuesday, December 6th, 2022. It is 10 a.m., 30 minutes after the opening bell of the New York Stock Exchange. Yours truly, Mickey Blindside here with your market memo. Okay, guys, today I wanted to go over primarily some of the minor changes I've made in our thesis, and this is just based on the last few days in the market. Some of the things we've noticed is the dollar is finding what appears to be an initial floor. Will it keep that floor? Who knows? No one's got a crystal ball to this, but we do have to now open ourselves to the possibility that the dollar may rally, that may send the markets down a little bit. And we're also seeing some outsized moves in volatility, not just in the equity VIX, the S&P 500 VIX. We're also seeing some volatility in the bond market, and I think that has some implications as well too. Also, yesterday, broad commodities down significantly. I mean, we saw a huge drawdown in crude oil. All right, huge drawdown. That's a huge drawdown in crude oil. It's like $5,000 per contract drawdown in the crude oil's contract. We also have nat gas, all the energy space pretty much. Yesterday, huge drawdowns. The grains as well. No commodity was safe yesterday. Everything had a drawdown. I mean, you could technically say it started at the end of last week, but it culminated into a huge sell-off, especially in the energy space yesterday. Actually, one thing I did not check was feeder cattle. Did it make a low yesterday? You know what? No, it didn't. Beef is one of the few things that seems to be holding up quite well, except today. But yesterday it held up actually quite well. And soy actually is well too. I noticed that soybeans didn't really sell off all that much yesterday either. But wheat sold off. Just broad commodities in general. DBC sold off. This, I think, was the biggest drawdown since June in broad commodities. Okay, so why is that? Right now, I don't know. I don't know why that's doing that. Are commodity futures traders just deleveraging for the end of the year? It could be. It could be that. Okay. So this could be just all just technical based. We'll see. We'll see what happens in the coming weeks. But I think this warrants a little change into our investment thesis going forward. Okay. So one of the things I wanted to go over first was oil. All right. We have considerable plans in oil. Over the weekend, I got into some oil spreads, which I got out at break even on Sunday evening just because I saw the dollar going up and everything. So this could also, the commodity space going down could also just be a reaction to the dollar going up. Yesterday, we saw the dollar really rally hard from that level here. So remember, we went long. Remember how we went long on UUP, which is the dollar index ETF. Once it hit this level, this green line, we got long, and what a reaction. And I told you there's a zone, there's a buying zone. This is the buying zone right here that I think that a lot of the central banks around the world, they're going to still keep buying dollars. A lot of institutions overseas that borrowed money and that issued bonds need to make those payments in dollars. So I still think there's going to be some demand as the dollar drops. You're going to see these bounces in the dollar. It's just how big are those bounces going to be? Is the bounce going to be big enough where it starts another uptrend in the dollar? Or is this just going to be a lower high, just a retracement, so to speak, and then we continue down? I don't know. No one's got a crystal ball to this, all right? But it does seem as if now this is acting like an initial floor. If we end higher for the week, all right, and if we really rally for the week, I think we could go, possibly all the way till around here, this 108 to 109.5 zone, all right, which is a pretty big move in currencies, all right. So anything priced in dollars is going to come down. Commodities, commodities generally do better in a lower dollar environment. Right now in this environment too, just with global volatility and with rates rising, and also in an inflationary period, the dollar rising also puts a lot of pressure on risk assets like the S&P 500 and U.S. indices as well too. So we could see a little bit of a pullback, into from the more delta neutral zones. We were above delta neutral on the S&P 500 for a bit. Right here, this 4,000 to 4,100 zone. We got a nice short here. Of course, I got out a little bit too early. Wish I had held it, but shoulda, woulda, coulda. We're now getting down into delta neutral territory. This 4,000 zone is around where delta neutral is. So right now, we're just coming back. It seems like we just pulled back to delta neutral. We'll see what happens, okay? Do we continue lower from here? Do we go higher? I think, again, it all depends on the dollar. Where the dollar goes, the market will follow, okay? So the big signal, I think, is going to come from the dollar. Now, other markets are going to take their cue from the dollar as well, too. One of them is energy. And, again, let's go over our thesis here. I am getting rid of all of our, I'm going to simplify our thesis and our watch list, okay? I realize now, after, doing some research over the weekend, it's just way too many tickers we're looking at. We're losing focus, okay? We are losing focus, and so this is very common, even amongst the pros. This is something that we always have to catch ourselves with. Once we, sometimes after coming off of like a string of wins, it's very easy to lose track of all your new ideas. You get excited because you're winning on a winning streak, and you start just adding all these names into your watch list, and, the discipline starts dropping, yada, yada, yada. So patience and discipline are your two best friends in this business. And so I'm going to exercise some discipline here and start chopping names off my watch list, okay? First name I'm taking off my list, Borr, B-O-R-R, off my list, okay? They're not even making positive profits yet. I don't even know why I even entertained this idea, to be honest, all right? So Borr, off my list. PLG, which is the Platinum Group. I still am bullish on Platinum, but I just don't think we're going to get a deep enough value. This is when I introduced PLG, I said this was speculative. Borr, B-O-R-R, also too. I said that was speculative too. It's deep sea drilling. They only make money when commodity prices sustain at high levels. But anyway, PLG, I also said was very speculative, as they are in a development stage. It is a very low dollar stock. I just don't think we're going to get a pullback big enough where it's going to warrant us taking that risk. And again, I moved it up to 161. Remember, we were debating between 140 and 161. Honestly, though, if you really want to be patient and really get your money's worth on this risk, I think you do have to buy this actually at 140, okay, or so. And the thing is, if we get to that 140 zone, that just means it's going to be psychologically really difficult for this to come down to 140. The dollar is going to have to go up. The equities are going to have to come way down. You know what? I don't think it's worth it. So again, PLG off my list. I'm still very bullish on metals, but no, PLG, no. I'm taking that off my list. All right. So all those names off my list. We talked about other speculative names like GTE and all these other energy names. All those names off my list. I'm not entertaining any of that anymore, okay? So what's still on the list, of course, is our uranium play, which has been, coming down with the dollar going up and Australian dollar also coming down. That also put a lot of pressure on uranium stocks. Uranium stocks across the board went down. All the metal miners did, actually, not just the big ones, but or the big uranium players, but just the whole metal space just came down, just really big yesterday. So I'm not too worried about that. On the next bounce, I will sell covered calls, buy protective puts as always. That's still on the list. We actually added another name to the list, is MATX, Matson, okay? MATX is the ticker symbol. I actually, on Discord, I gave you guys an alert. I already bought a June, and because that's all it goes to, June 2023 in the money calls. My in the money calls are a little bit in profit already. We bought it, I believe it was like 9:30 or so. This is something that I'm going to be doing poor man's covered calls on, which is, you buy in the money calls that are longer dated, and you sell shorter dated out the money calls. I'm actually looking at the January calls right now. I'm looking for this 70 call. If we get a little bit of a pop in the market, or if we get a pop in this stock, I may be selling this 70 call right here and bringing down my cost basis of this long-term call option. So that's the premises of the poor man's covered call. So, the reason why they call it a poor man's covered call is because instead of generating that covered call through owning 100 shares, I'm doing it through a cheaper in the money call, right? So if I wanted to buy 100 shares of this and sell one covered call, I'd have to put $6,100 of premium. I'm sorry, $6,100 of buying power into this stock, right? $61.55 times 100, $61.55, all right? I'm just rounding numbers right now. But yeah, I would need to buy 100 shares in order to sell that covered call. Well, instead of putting down $61.55 down to sell that covered call, I just put down $930 and per contract, and then per contract I can sell covered calls on that. That's why they call this the poor man's covered call. You don't need any additional collateral in order to sell that covered call, as long as you're selling out the money and you're buying in the money calls, okay? The reasoning behind that is because let's say I bought, like in this example, I have the 60 covered calls. Let's say by January, the January 2023, the shorter dated, I sell the 70 calls, and let's say on January options expiration, it ends at $71, okay? That would mean I get assigned, right? I get assigned a short position. If I'm a call seller and my call goes in the money, I'm obligated to I'm obligated to sell at 70, okay? I'm obligated to sell, but I've got the right to buy at 60, right? So that's where I collect my premiums. So, and so if I do get assigned on the 70 calls, I can always exercise my 60 calls. All right, buy for 60, sell at 70. I collect my $10 per share. I paid $9.30 for this, plus I got paid, let's say, 90 cents on this. I guarantee myself a profit if this stock were to just rally past 70. All right, the worst thing that can happen if this thing just keeps rallying is that my profit, gets capped. That's all it is. All right. Of course, if it goes down, then I can lose this. So, also it makes it more capital efficient. Just in case if we do see a downturn, I'm not putting as much capital at risk. All right. So that's the reasoning behind the trade that I did. But again, Matson Incorporated is a shipping maritime company. Its valuation is quite low. It is a very low valuation. It had its EPS go up quarter after quarter for the last couple of years. And also, too, I think it's a very good candidate to increase their dividend. If shipping rates continue to remain elevated, I think it is a very good candidate to raise their dividend. I think that's going to get the stock to go up. Some of you may be noticing that it's got a little bit low volume. The volumes on average are about, maybe a few 100,000 shares. Maybe every once in a while it gets to 1 million or so. Shipping maritime stocks tend not to be the most liquid of stocks to begin with, but this stock is actually mostly institutionally owned. It's about 80% owned by institutions. Most institutions are not day trading this, and most of the institutions that are owning this for the long term. So you're not going to see a lot of daily big volumes. Usually on the big day volumes are the big sell every once in a while, you see big buys as well too. But these are institutional names that are more long-term focused. So you're not going to see a lot of daily volume in this. Okay, so I've kept my positions pretty small in this. Again, this is just an initial position. My main position in maritime shipping, I want FLNG. Okay, I really want this name. Now, this name is a little bit more exposed to the commodity markets. Matson is not. Matson actually, not only do they do commercial tankers, services for energy companies, they also do actually a lot of other things like automobiles, clothes, general dry bulk, all of these things. So it's more general shipping. They do have some energy tanker deals as well too, though. Okay, so they do have some energy exposure, but more general shipping. FLNG is more natural gas shipping. That this is the energy tanker name. Okay, they have a very new fleet. All upgraded. They're also, they're also discussing increasing their dividend. Also, I think another good candidate for that, although not as good as Matson. I think it's got a little bit more debt, so they might take a little bit longer to pay off that debt. MATX has far less debt, and I think this is the shipping name that is preferred by institutions. But FLNG also, I think, poses a very good opportunity as well too. I'm waiting for these lower levels. If we get to these lower levels, I'm going to be buying leaps on FLNG as well too. Right now, I am looking at FLNG, and we've already talked about this last 2 weeks. This is part of our thesis from 2 weeks ago. This is the part that I'm keeping. January 2024, I'm looking at these. January 2024s, possibly even January 2025s, depending on the skew and depending on what premium we can get it at. Actually, that's not so bad at the 30s. What's 30 here? Maybe a little bit lower, but not by much. Gives you a little bit more time. 7 for the 35. 8. Okay, so we'll see. We'll see what happens. It really depends on IV as well too. Which series is going to give me a little bit more value? I might put a few stink bids when I do this. And from a few weeks ago, or no, a few months ago, back in September, I showed you guys how to do stink bids. We used IWM, and we made a killing off those stink bids. Remember, those stink bids filled, and we made like, I don't know, I think it was like 70-80% in a matter of like a week or so on those longer dated calls. So sometimes they work out very well. So that's what I'm going to be doing with FLNG. I'm going to be putting some stink bids out once it gets to around here, 35, 33 or so. We shall see. I think I might split up my buys, do a buying around here at 35, do another buying here at 33. And again, part of that thesis is I think shipping rates, will continue to go higher. If you, some of the naysayers, they're saying shipping container rates are coming down. I mean, zoom out the chart just a little bit, don't be all, looking at just, short-term charts. If you look at the long term, okay, we've had these rock bottom rates in shipping for like a few years because we had basically an oversupply of tankers and containers back then. Well, now we don't. Because we had such an oversupply then, they stopped building all these new ships. They stopped upgrading and stopped building. Okay? So what does that do 5-10 years down the road when there's an oversupply? There's a saying in economics, the way to get price to go up is to oversupply the market. Once you oversupply the market, all the producers stop producing, and then within a next cycle, you have a shortage. Boom, so, how do you get prices to come down? You create a shortage. Price goes up. All these producers start, producing, and, supply gets dumped into the market. Prices come down. All right. And that's funny how that works, right? So we've had this shortage of tankers and containers. Okay. And then we had this impulse, like this, this, oh my gosh, like, we're short, we don't have enough tankers. And then we had this initial move. Then after around 2021 or so, it started coming down. Now, if we look at it on a more longer term basis, all right, if we look at things on a longer term basis, I do think that over multi-year course, we are going to see an uptrend, I think, like a monthly chart uptrend. I think this is just a retracement of that. And just like the commodities market, the freight market is extremely volatile. This like 20% rule, like you know how like us equity traders and people in the S&P 500, they always say, oh, a bear market is whenever the market drops 20%. Well, in that case, there'd be bull markets almost every year in commodities and freight rates can go up and down 30, 40, 50% in a year and still maintain an uptrend. Okay, that's just the nature of the markets in that arena. All right. If we look at the Baltic Dry, which is a very good indicator for what's going on with shipping rates, I do think that we're still in this long-term, monthly. Well, it looks like now in a short term it's in a downtrend, but again, I think in a multi-year, I think this is going to curl back up. And again, it's look at shipping rates from other boom bust cycles too. If you look, it's rarely just one move and then it just goes down and flat again. Okay, it usually goes up and then it comes down, it goes up again, it spikes up again. And usually the second spike is bigger, kind of actually like inflation back in the 70s. The second spike was actually bigger. So just like other commodities, usually you see a spike, a retracement, and then a bigger spike afterwards. Very possible, and that's part of my thesis. I do think that there's still a shortage of tankers, and if you look at some of the new orders coming in, and there are companies right now ordering new tanks to be made. They're not going to come out into the market until 2026, 2027 at the earliest. At the earliest, they're going to come out 2026, 2027. And again, there's a aging fleet out there that needs major upgrades, and that will also take time and supply away from the market. So I do think, overall that this is going to curl up again soon, maybe in a couple of months. All right, in a couple of months, I think it does curl back up. If we are wrong, I think something like MATX is going to actually show us sooner, because if you actually look at Matson, it's very well correlated to the Baltic Dry Index. And so if we do see MATX closing, down, and I think if it closes below around, let's say, I think I had my levels here. Yeah, this level right here, this was it. If we close below this 60 and a half, let's say, around this zone, the lows right here, if we close lower than that, then I'm going to get out. I'm going to get out of the June calls. Okay, so that's my level to look at. All right, so right now we're at the edge of price structure. All right, and this is where I like to enter my trades. This is like kind of like the make or break moment. Those are usually the best trades, because make or breaks, generally when you're wrong, and it doesn't take much to know that you're wrong. Okay, it's not like, oh, let's keep it going for a little bit, to see if we're gonna be right. No, when you're wrong because you're at the edge already. Okay, we're at the edge. So if we close for the week below the lows right here, the September 29th weekly lows, which is what, 60.35. Okay, so if it closes a weekly close under 60.35, I get out. I get out of the whole trade, and we have to rethink this shipping thesis. All right, so that is part of the shipping thesis, and that part hasn't really changed. MATX, I'm still looking at this. I'm not going to be adding any more to this, because what I really want to add to is FLNG. So I'm waiting for FLNG to come down. I think this is FLNG. Not only does it have that shipping component, but it also has that commodities and energy component to it. So I do think that if the dollar goes up and if energy prices really come down, we may see these prices get hit. Speaking of energy prices, let's talk about our energy thesis. And again, we just got rid of a lot of names in our energy thesis. Again, a lot of that is due to, I think, the dollar going up. Here's the thing: crack spread. Remember crack spread? All the distillates that are made from crude oil, like diesel, gasoline. Diesel is actually really hard to track for a lot of retail traders, so that's why I use gasoline a lot. It's a good proxy to use for the distillates market. But we are seeing the crack spread narrowing, okay? When the crack spread narrows like this, the economics of buying more crude for refineries changes, okay? When the crack spread widens, refineries will buy all the oil they can and produce gasoline or distillates, okay? They got every reason to do it. When the crack spread narrows, the economics becomes less and less favorable to keep doing this in mass, okay? We are seeing gasoline prices really plummet. I thought, okay, that, this pullback from last week, I thought, this is just the winter months. This is going to make a higher low, and it'll probably just make a box and then start going up next year. That's what I thought, okay? However, yesterday's move and, this lower low now, and if we close over here and then for the week, if we keep closing, if we close lower than this, like right here, what is this in gasoline? A little bit over 2.25. If we end the week under 2.25, all right, that I think will force refineries who have been buying crude oil in mass to produce all of these distillates. I think they're going to start dumping paper oil, so futures contracts, into the market, okay, to hedge all the supply that they have. All right, so this could be like a weakness begets weakness situation. Okay, this could be a weakness begets weakness situation where if the crack spread just keeps narrowing because of the inventory that a lot of these refineries have, they will have to start hedging, which means they'll have to sell crude oil contracts. All right, so this could really go down. So I'm putting my oil buying on hold. Okay, I'm keeping it on hold. I thought that we were going to see, we remember last week we already talked about contango, forming within the oil futures market. We talked about this, I think, last week or the week before. And so that was one of our warning signs. That was the warning sign I gave people. Yo, if you're gig along on oil names, this is the time to start, really managing your risk. Thank goodness I noticed that, because, I think, this is a sign of that. What I thought was going to happen was that I thought the oil market, it was going to still have a floor because of the crack spread. And I thought we were still going to go up within oil and then maybe sell off around January, February, when the market realizes there's an oversupply of diesel and gasoline. I thought it was going to take a couple of months for the market to realize that. I don't think so. I think the market's kind of realizing that now. And I think oil may be in for some tough months ahead. And perhaps it may not be the right time to be buying more oil names. Maybe in a couple of months or so. And when I mean oil names, I'm talking about the producers and explorers, not necessarily like the midstream, like, your tankers. I think tankers actually could do better. Oil tankers could actually do better in this environment, because as there's contango, there's a greater demand for oil storage in contango. So usually if there's a contango where the back months are more expensive than the front months, and if contango steepens, there is an incentive for traders to buy front month, get the delivery, store it if storage fees are low enough, and then sell it later on for a higher price. All right. And so, there's an incentive now to do that if we start seeing heavy contango in the oil market. So not necessarily, this is not necessarily bearish for the midstream, but definitely for the upstream, for some of the oil producers and explorers, this is going to be a problem. Okay. And so that's why I got rid of all those names. If we are to get back into the explorer space, I already have, Chevron in my Forever account, so I do have exposure to this. Thank goodness I sold some covered calls there. That was good. That was a pretty good yield. If I am to get into another name, a more junior oil producer, I'm actually now adding CPG to my list. CPG, okay? Now that the oil market is showing signs of tightening, I want to only be in names that are buying back their shares and increasing dividends. Okay, I want quality. Okay, and right now, just from what I saw from all the oil miners and I'm sorry, the juniors, this is one stock that is doing that. They're actually increasing their share buyback and increasing their dividend. They actually paid a couple of special dividends recently this year. So this year, I think they announced they 1, 2, 3, 4 already 4 dividends this year. There's a possibility of a 5th dividend at the end of this year for this name. Okay, so this company also a lot of their earnings comes from natural gas as well. They got a good natural gas exposure as well too. Okay, so not only just in oil but natural gas. Also, they're buying shares, increasing dividends. So when the time comes, and when I do think that oil starts going higher, because I do think commodity prices will continue higher into next year, but I just think before that happens, we're going to see some pain. All right, so we might see all the oil names really pare back. We could even see this CPG come into like $5 zone, $5 zone. That would be a major value for this company. Okay, and again, their free cash flow growth is increasing. They're buying back their shares. They're increasing their dividends, and it's a pretty low dollar stock, and a more of a junior oil name. So it's got a lot of room to run if the oil market runs again sometime next year. Okay, so I'm looking at CPG as a next oil acquisition, but again, I want value, and I'm going to not act on this until I see the crack spread improving. We're not going to see crack spread improve unless gasoline prices go up and other distillate prices go up. And yesterday, it was just a really bad day for all commodities just across the board. So that's why I felt like the need to change our thesis. As the oil market gets tighter, I'm not gonna do deep sea drilling anymore. So deep sea drilling out, bore out, all those names that are a little bit more speculative, all of them are out the door. Okay, so we're going back to quality. And again, I should have done that from the beginning, but again, it's a human condition. You have a few wins under your belt, and all of a sudden you start getting too cocky and you start adding names you would normally not add. No more of that. Luckily, we caught ourselves, or at least I caught myself before I acted on that. It's always important to kind of center your frame of reference always at times. That's why I always recommend after a string of wins or a string of losses, you take a little break, all right? And it's very common to do that, especially in world-class militaries. They do this too. If you're in the special forces and you do a very sensitive mission, after a successful mission, all those involved usually take about a week or 2 leave of absence. There's a reason for that. Or not a week or 2, but it's actually a few weeks. But the reason for that is because when you're coming off a string of victories, it's very easy to start making mistakes because your confidence gets too high. So it's a good thing we caught ourselves with that. And again, patience and discipline. Okay, so those are my change to my thesis overall. Also, too, because we're not in PLG, or we're not really looking to get into PLG anymore, at least I'm not, it's really hard to find a platinum or palladium miner that's really that has really good fundamentals and quality, at least here in the United States. If you go actually into other stock markets like Australia, South Africa, and places like that, there are some quality names out there. One that comes into mind, I can't even show it on this, but there's some out there, but in the U.S. it's really hard to find. So I may have to focus more on names that are listed on the New York Stock Exchange, like Barrick Gold, or even I may just switch over from platinum, palladium, and just get more into like gold miners and silver miners, to be honest. So on the next pullback on this, if the dollar rises, okay, so here's now where we get into the dollar thesis. All right, the dollar I do think is going to go up and retrace. Okay, now the only question that nobody knows, I don't know, you don't know, nobody knows, is it going to make a higher high? Or are we going to continue this uptrend? Okay, are we continuing this long-term uptrend in the dollar? Is this just one pullback and we're going to make a higher high on the weekly long-term trend? Is that the case? Or is this just a retracement and a bounce, like a dead cat, for example, and we're going to stop it around 108 to 109.5 or whatever, and then curl back down. That makes a lower high and then come back down again. So are we in a new downtrend, short-term downtrend, or are we continuing this long-term downtrend? I don't know, okay? But at around this 109, 108.5, 109.5, if we start seeing an exhaustion signal, or if we see dollar curling down and it looks like as if this is going to be a lower high, that's when I'm going to get into the to more metal miners, okay? And again, I might just do poor man's covered calls, buy some leaps on like a ETF like GDX and SIL. That's actually usually where I excel, just because I don't like to deal with individual company drama. Although if I am getting into an individual company name, Barrick Gold would be one that I really consider. And then I'd be doing some leaps. Actually, the leaps on Barrick Gold are actually not that bad. Okay, you got actually some decent open interest on there. I might also do GDX as an ETF and just not deal with individual company risk. GDXJ, the junior gold miners. When the gold miners run, GDXJ runs even more, okay? So GDXJ, not bad, although the options market is not as good as GDX is. It's still decent. SIL, silver miners, I may do the silver miners. It's kind of like GDXJ when it comes to the open interest and such, but I may go with the silver miners. I don't think the junior silver miners, do they have an options market? Oh, they do. Actually, why is it that the junior miners actually have more expirations than the non-junior miners? That's interesting. That's very interesting, actually. Oof. But their options market is just not as well. It's not that bad. It's not bad. It's not bad. So I might go with the silver junior miners. Okay, I might go for the silver junior miners. Okay, let's do it. And silver, when gold and silver move together, usually silver makes bigger percentage moves too. So it's a little bit more leveraged. So okay, I might go for the silver miners. So again, I'm changing the thesis a little bit. I'm still in uranium. But instead of the palladium and platinum, just because it's so hard to find a good quality name in palladium and platinum, I'm going to be switching over, I think, to more precious metals. Silver, I think first, silver and gold, and then we'll look for opportunities based on where the dollar goes. So again, it's just based on the dollar. We're just exercising a little bit of patience here. We know what to look for. All eyes on the dollar chart. That's what the theme is for the next few weeks. Anything you guys want to look at? You could put it in the voice chat text if you're on Discord. If you're joining us from our social media pages, go ahead and put it on the chat. Somebody just mentioned SI silver by AG. Yeah, AG, I know about AG. AG, this is a silver miner. I've seen this a lot, a lot of people getting involved in this. There's some like positive catalysts with like new mines and new supply that they have. I'm not sure if they have a good options market. Oh, they do have an options market. Okay, I'll have to do a little bit more research on AG. I've heard of AG before. But it's just not a name that I've done a lot of fundamental research on, but I will. Oh, you know why I didn't do fundamental research on it? It's because the options market was so thin on this. Actually, no, it's not that bad. The January 2024 is not so bad. It's not so bad, actually. IV's not so bad. Okay, so I'll do a little bit of research on AG, and I'll report to you guys on this later this week. Okay. Good find, by the way. AG, but I have to do a little bit more homework on that. Anything else you guys want to look at? Any other questions, comments, rude remarks? I see people typing, so let's give it a minute here. Oh, no. That's somebody made a comment on Discord. I wasn't referring to that when I said rude remarks. If you look back in our videos, I always ask for comments, questions, comments, and rude remarks at the very end. It's something I always say. I used to do a lot of a client business, and I would always, at the end of every presentation, I would always ask that, just to lighten the mood. When you talk about a lot of serious things, it's good to lighten the mood every once in a while. I always say that. Yeah. Oh, the mini bull market. Oh, so you guys, okay. So, I actually did not. I was going to actually go over that tomorrow, but since you ask, we might as well go over it. Okay, so one of our Discord members asked about the mini bull market that's forming, that potentially could form. This is a thesis that I had back in, back in the summer, probably around July or August, okay? This is what I said. So back then, we had this dash for cash. Remember, with short term, this is the 5-year treasury bond futures. So as this was going down, actually, you know what? I know some of you guys, it's hard to think in terms of futures prices and this and that. Let me actually go to the chart here. So yeah, if you look at the short-term interest rate, so back in, let's see here, back in June, July, we saw short-term interest rates really go up, right? And this caused this dash for cash, all right? We saw this dash for cash in the markets. Even though the S&P 500 was going down, the VIX was going down with it. Now, why is that? Remember, back then, it was because the hedging demand wasn't there. We actually saw some institutional selling happening in the summer in a lot of stocks, okay? We saw a lot of institutional selling. Beforehand, when interest rates were low and when cash was trash, hedging demand would go up every time we see, a pullback in the market. We would actually see hedging demand. So the VIX would spike up as the markets went down, all right? But as interest rates go up, there is an alternative. TINA is no more. TINA is there is no alternative. When interest rates go up, there is an alternative. When the dollar is in an uptrend and interest rates are going up, there is an alternative. The alternative is holding cash and getting short-term interest off of it, okay? Dollar-denominated accounts in foreign countries were paying 4 or 5%. So if you were a money manager overseas, it made a lot of sense to cash out and put your money and make 4 or 5% for the year and get half of your quota that you needed to keep your job, all right? Same thing in the United States. There was this, a lot of fund managers were able to pull their money out, put their money in a 6-month, 1-year bond and make 4+% on it. And again, make half the quota that they need to keep their job. So there is an alternative. People sold. The demand for hedging went down. So even though the market went down, the VIX went down. So now here's the thesis. Okay. Now, what happens when things normalize? What if, okay. And the reason why I want to go over it today too, now that somebody asked, is because if the dollar makes a downtrend. So we do have dollar calls, so I do think temporarily it goes up. But let's say it makes that that lower high. Let's say the dollar makes a lower high, falls down, okay, creates a medium-term downtrend. At the same time, our liquidity signals, okay, like our junk bonds ADL, for example, also make a higher low. Let's see here. Okay, let's say it makes a higher low. Also, our New York high-low line at least is not decreasing, but is flattening or increasing. So if our liquidity signals stay stable or are increasing, at the same time, the dollar makes a downtrend and interest rates come down, what we could see is that as the market pulls back, we see outsized moves in the VIX, which means hedging demand is coming back. We are seeing a lot of hedging demand, at least in the short term. But if you actually look at 3, 6, 1 year out, which is what most institutions hedge for, it's actually still quite it's not as big as what it could be based on projections from previous years. Okay, so as hedging demand in individual stocks and whatnot, as they increase, we're going to see outsized moves in the VIX for every pullback and SPY. I think that would be a signal that we are going to see a rolling bull market, okay? A rolling bull market, but that will be a mini bull market in my opinion. We saw something like that back in the 70s as well too. Let me go back. This is gonna take some time, but I think it's worth it. And where is US CPI? Okay, so, and this goes along with our inflation thesis as well too. Weekly chart. Yeah, right here. Okay, so back in the 70s also too, we had initial inflation actually starting in around 69.70. Okay, so we saw that initial inflation, markets went down, we had a bear market, and then look at this, we actually made new all-time highs in the mini bull market that was in between. And then this is where we had Yom Kippur and then all the oil crisis and all that. And we saw another spike in CPI. Look at this. The CPI, see, CPI went up initially. And then, they started tightening. And then they loosened right here. And then there was an oil shock. And then we spiked up here. They tightened a little bit again. They loosened again. So, inflation is a very sticky problem. Okay. And so in between, I would consider this to be one bear market, but in between that bear market, we can see these mini bull markets. Okay, and I think the next mini bull market, that signal is going to come from the VIX. When we see all of these things like dollar going into a downtrend, interest rates falling, liquidity improving, and at the same time VIX is making outsized moves, that just means hedging demand is coming back. And as the hedging demand comes back, all those puts actually feed into a rally, okay? And so what we might see is money entering into the market, but in different sectors at a time. So it's not going to be like broad stock buying, but it's going to be like sector by sector buying, and this kind of rolling low liquidity bull market that could last for a couple of months. And then I think inflation comes back and we see volatility again. That's just my opinion. That last part is my opinion, but there's already data suggesting us that within the next couple of months, we might see that rolling bull market happen. When's the last time we had a rolling bull market? It was actually back in 2017. Back in 2017, we had a rolling bull market. Of course, market conditions were very, very different then. So I'm not saying that it's going to exactly be like that, but that is just an example of what a rolling bull market is like. It's not, it's money's entering the market, but it's not buying everything at once. There's certain sectors that outperform, certain sectors that are in a bull market, everything else is kind of flat, and then it just rolls. It's a very low VIX kind of rolling bull market. And you can see here, there's very, very few drawbacks. And even when there are, it just really isn't, there's not, the pullbacks are just very, very shallow. Okay. And really that bull market, that rolling bull market where it was the least volatile, it was around here since August to around, let's say, January or so. We had, there was a lot of news on the Trump tax cuts, and that's when, once in a while you see these, big red candles. But other than that, it was a very, very stable rolling bull market. And that's usually when day trading, when your edge goes up in day trading. And so I remember then we made a killing. Well, I made a killing just day trading this. I think there may be an opportunity for that. Already the setup in the data is there, okay? We just need to see the dollar trend go down, again, make that lower high. Interest rates stay stable, liquidity improve, VIX makes outsized moves, which means that there's hedging demand coming back into the market. Then we can confirm that that is going to start. But again, I think that's like a few weeks to a couple of months away at least, all right? So that's the rolling bull market, mini bull market thesis. And again, I think it's going to be a mini bull market. I think the Fed is going to bend as they see. I think this CPI, and CPI is next week, by the way. I think either this one or the next two ones. The one that gets announced in December, January, or February. One of them is going to see a really, really large decrease in the CPI. Okay, there's going to be a big decrease in the CPI in one of those reports just based on the commodity prices, what has happened 6 months prior. And when that happens, I'm pretty sure the Fed is going to start, they already started talking about moderation, all right? Already the tone of the Fed is already changing, okay? And this is something that we predicted back in September, okay? I said within 30 days, there's going to be a quote-unquote pivot. Pivot doesn't mean an interest rate cut. It could mean just a change in tone. It could mean just a slowing down of the rate increases. But I said it was coming, right? Here you go. 30 days later, here we go, okay? Or 90 days later, here we go, okay? So, this is something that we've already noticed and we've already been anticipating. I do think, though, that one of the next couple of ones, we're going to see an outsized move down in the CPI. I think Powell is going to use that to kind of lessen the rate hikes. And of course, it's going to be too soon. It's going to be too damn soon. And what's going to happen is inflation is going to roar back into end of 2023. I think at the same time as there is an emerging market solvency issue. And, we had an emerging market solvency issue back in 97, 98, the IMF Asian financial crisis. Back then, inflation was low, so the Fed was able to cut interest rates and add liquidity into the market. Well, if we have a emerging market solvency crisis at the same time we have roaring inflation coming back, the Fed has no weapons at that point, okay? So I do think we are headed in that direction. I don't think it's going to happen in the first half of 2023. I think that's more of an end of 2024 situation. So between then and now, we might see this mini bull market. All right. That's more like my thesis for the next 2 or 3 years. So I hope that clears everything up. Any other questions? Questions, comments, rude remarks, anything? Somebody from YouTube asked, from chat asked, is this the time to buy TLT? TLT, TLT could go up. I'm not saying it will go down, but I think at some point, when it comes to bonds, you really want to think a little bit more long term. The chart that you want to watch for bonds, anything bond related, is more so weekly and monthly charts. I think right now it's getting long. It's a little late, but it could still keep going up. But what I'm more interested about in this is after it gets. If we do see interest rates drop, I do think if Powell starts getting soft, I think starting next year we could see really a TLT really move up. I just don't have a trade on this just because I wouldn't know how to manage risk on a long trade because it could just fall flat again if inflation roars back. And any one of the CPI reports after like January, February, if CPI roars back, TLT is just going to drop. Okay. So my next trade on TLT is actually to short it. I just want to short it at higher levels when when we start seeing those inflation numbers come back. So that might be like 6 to 9 months away. So I might not be touching TLT for at least another 6 to 9 months. Okay. So I don't have a trade on TLT. Yeah. Anything else you guys want to look at? Going once. TQQQ. Oh my goodness. Ugh. This is just, disgusting. Why? Why would you do this to yourself, man? Why would you do this to yourself? I really don't know why you would do this to yourself. Although I've been known to take a TQQQ trade myself, the only way I would trade TQQQ is to buy like a low delta leap on this when I thought the market was bottoming. Okay, when I thought the market was bottoming and we're gonna see like a year or two of stable growth ahead in the stock market, maybe I would buy a TQQQ LEAP. Okay, but buying shares of this, no. Because you could do way better just using triple Q LEAPs. You could do a poor man's covered call right now. I mean, you're probably doing TQQQ because you want a leverage long on tech and at the same time sell covered calls, right? Is that the reason why? Is that the reason why, Noah, that you wanted to get into this? Yeah, okay, there you go. So instead of that, I want money. You want money. Okay, well, I just think there's better ways. You got a lot more liquid of a options market in QQQ. So you can sell, actually, you can now sell almost daily premium on QQQ. If you don't have enough to buy 100 shares, buy a leap on it. Okay, let's actually take a look at it together. QQQ, you can actually buy like you can do a poor man's covered call. Let's say you want to give yourself a year, fine, buy yourself a year out in the money call. Let's look at Delta 76 right here, 240. That's 66.37. So each contract is $6,600. So instead of paying $28,000 for 100 shares to be able to sell one covered call, why don't you just get one of these in the money calls, in the money leaps? That's, what is this, $6,700. That's pretty much giving you almost 4-to-1 leverage, almost 4-to-1 because your delta is really high. Okay, that gives you a 4-to-1 leverage, and at the same time you can sell daily covered calls on it and decrease your cost basis on a daily basis. I just think this way is better. But that's just me. It's not financial advice. You can do whatever you want. Okay. Yeah. Oh, it seems pretty smart. Well, because it is. It is smart. Okay. It's way smarter. With TQQQ, the problem with TQQQ2 is that you also have like tracking error because it's like what 3x a day, right? So based on the order of returns, you may have severe tracking error, and that's just part of being in a leveraged ETF. All right, so that's why I just don't like TQQ. I just don't like these leveraged ETFs. I just don't. But that's just me. Again, that's just me. FNGU. What is FNGU? What is this? Bank of Montreal. Microsectors FANG index. I don't even know what this is, man. FNGU. It's an index? A FANG index? 3x on FANG? Triple leveraged FANG? No thanks. No thanks. No thanks. This is you're no thanks. You're long on this? Good luck. Okay, good luck. I wish you all the best. Fun money? Okay, that's fine. I mean, I'm not saying tech is going to fall, but if the dollar goes up, you're screwed. All right? If the dollar goes up. Yeah, if the dollar goes up or if TNX goes up, that's a losing trade right there. So be very careful. Although if the dollar makes that lower high and comes back down and we start seeing a downtrend in the dollar, tech is going to like rally really hard. Yeah, if there is a rolling bull market, you're going to be rich. But I think the timing is too soon. Too soon. Just based on the data, I think it's too soon. Maybe by a couple weeks, the first through the door gets shot. That's a good piece of advice to listen to. Perhaps you should have listened to that yourself. Yeah, I'm not getting involved in any tech names right now. Not when the TNX is where it's at. Not when the dollar is doing what it's doing. I mean, this could just be a pullback, right? What if it makes a higher high? All tech stocks are going to get dumped hard. It's going to get dumped really hard. So we don't know that. We don't know that yet. We don't know. Okay. So it would just be gambling, in my opinion. Okay, going long on tech is a gamble right now. There's nothing to suggest that this is over yet. Okay, the setup is there for it to be over, but we need confirmation to stay disciplined. We would need confirmation. Okay. Anything else you guys want to look at? Wow, we did a full hour today on Market Memo. We haven't done a full hour in a long time. That was good, guys. Thank you for the questions. Thank you for staying interactive with me. Thank you for joining me. First of all, I know you could be anywhere else in the world, but you decided to be here with me, and I do appreciate that. So that wraps up our session of the Morning Market Memo. Our Discord invitation link is in the description below. Come join our Discord. Be a part of our growing community. No sub fees, no paywall. It's of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. All right, I'm going to be back tomorrow and Thursday, 30 minutes after the opening bell in the New York Stock Exchange, 10 a.m. Eastern Time. Hope to see you guys then. Have a wonderful day, guys.